Listen up, because I'm going to say something right now that your financial advisor, your bank, and your boss are all too polite or too financially motivated to tell you directly. You are one phone call away from losing everything you've built. One layoff notice, one diagnosis, one market correction, one restructuring memo from a CEO you've never met sitting in a boardroom you've never been in, and the entire financial life you have carefully constructed over years of early mornings and late nights can disappear before you finish reading the subject line of that email. That is not a scare tactic. That is arithmetic. If you have one job, one paycheck, one income stream, you do not have financial security. You have financial fragility dressed up in the costume of stability. And the terrifying part, most of you watching this right now have exactly that. One stream, one thread, and you are calling it a plan. If what I just said made your stomach drop even slightly, then you are exactly who this video is for. And you need to hit that subscribe button right now before we go any further. Because what I am about to lay out for you, 7 specific buildable income streams that you can start constructing without quitting your job, is the kind of financial framework that people pay thousands of dollars to learn in seminars and master classes. You are getting it here free in the next 25 minutes. Subscribe, hit the bell, and pay attention because I do not repeat myself. Now, let's get into the real conversation, and I want to start with a number 82. That is the percentage of American workers who, according to multiple financial surveys, could not cover 3 months of expenses if their primary income disappeared tomorrow. 82%. That means if you are sitting in a room with 4 other people, statistically 4 of you are one bad quarter away from genuine financial crisis, and you are all walking around pretending that your direct deposit is a strategy. It is not a strategy, it is a dependency. And dependencies are vulnerabilities. Every serious entrepreneur I have ever competed against, invested in, or built alongside understood one thing intuitively that the average worker never figures out until it is too late. The goal is never to need any single income source so badly that losing it destroys you. The goal is to build so many legitimate revenue channels that losing one is an inconvenience, not a catastrophe. That is the difference between people who retire with options and people who retire with regret. So let us talk about the first income stream. And I want you to understand up front that this one is not going to excite you. If you are looking for excitement in your financial strategy, you have already lost the game. Dividend investing is the first stream, and it is the one that has quietly made more ordinary people wealthy than almost any other mechanism in the history of markets. Here is how it works, stripped of all the financial jargon and nonsense. You buy shares in companies that are profitable enough and confident enough in their future earnings to pay their shareholders a regular cut of those profits. Every quarter, sometimes every month, those companies send money directly into your account simply because you had the discipline to own a piece of them. You reinvest that money, you buy more shares. Those shares generate more dividends. Those dividends buy more shares. And that cycle repeated without interruption for 10, 15, 20 years is called compounding, and it is the closest thing to a mathematical guarantee of wealth that exists in the legal, financial, and world. Here is a concrete number for you. If you are 35 years old and you invest $500 a month into a diversified portfolio of dividend-paying stocks, with an average yield of around 3% reinvesting every single payment, you are looking at a portfolio that generates somewhere between $40,000 and $60,000 per year in passive dividend income by the time you are 65. You did not build a startup. You did not take a second job. You bought ownership in businesses that were already working, and you let time do the mathematics for you. The only thing that can derail this strategy is you, specifically, your panic during market downturns and your impatience when the growth feels slow. Do not be your own worst financial enemy. Set up automatic investments, reinvest dividends automatically, and then get out of your own way. The second income stream is index fund investing. And before you tell me you already know what an index fund is, let me ask you something more important. Do you actually own any? Because there is a profound and expensive gap between knowing what something is and actually doing it. And most people I talk to live permanently in that gap. An index fund is simply a fund that tracks a broad market index, the S&P 500 being the most common, which means when you buy into it, you own a tiny fractional piece of 500 of the largest companies in America simultaneously. You are not betting on one company, you are betting on the American economy as a whole. And here is what the historical record tells you about that bet. Over every 30-year rolling period in the history of the S&P 500, the market has been positive. Every single one. Through wars, recessions, pandemics, political chaos, and every other flavor of catastrophe that humans have manufactured, the broad market has gone up over time. That is not a promise about next year, but it is a very powerful statement about the long game. The mistake people make with index funds is behavioral, not mathematical. They buy in when the market is high because it feels safe, and they sell when the market drops because it feels rational. But that behavior, buying high and selling low, is the most expensive financial habit in America. The people who built real wealth through index funds did one thing differently. They treated downturns as sales. When the market dropped 34% in March of 2020, the wealthy people I know were not panicking. They were buying because they understood that a company worth $100 on January 1st does not suddenly become a company worth $66 worth of actual business just because the stock market is having a panic attack. Price and value are not the same thing. Learn that distinction and it will be worth more to you than any individual stock tip anyone ever gives you. The third income stream is real estate. And I want to be precise here because when most people hear real estate income, they immediately picture buying a rental property, dealing with tenants, fixing toilets at midnight, and they talk themselves out of it before they even run a single number. That is a failure of imagination. The entry point I want you to consider first is a real estate investment trust, a REIT. A REIT is a company that owns, operates, or finances income-producing real estate. Apartment complexes, commercial buildings, warehouses, data centers, healthcare facilities, and by law, REITs are required to distribute at least 90% of their taxable income to shareholders. 90%. That means when you buy shares in a quality REIT, you are immediately plugged into a stream of regular income generated by real estate assets worth potentially billions of dollars, and your only management responsibility is deciding how much to invest. No tenants, no maintenance, no property taxes, no 3 a.m. emergency calls about a burst pipe. You are buying the economics of property ownership without buying the headaches of being a landlord. REITs typically offer dividend yields between 4 and 8%, which is meaningfully higher than most dividend stocks, and they trade on public exchanges the same way stocks do, which means you can start with whatever capital you actually have today, rather than waiting until you have saved a down payment. This is the income stream that most middle-class people ignore because it does not feel real enough or exciting enough, and that is exactly why the people who do use it end up miles ahead of the people who dismissed it. Now we get to the fourth income stream, and this is the one that I find most people are systematically undervaluing. That stream is the monetization of knowledge, your expertise, your professional experience, your hard-won understanding of a specific domain packaged into something that earns without requiring your constant physical presence. Think carefully about what you actually know, not what your resume says, what you genuinely, deeply, practically understand that other people are struggling to figure out. Have you spent 10 years in sales management? Then there are sales professionals right now who would pay for a framework that compresses your decade of learning into 6 hours of structured content. Have you mastered project management, nutritional science, legal writing, mechanical systems, classroom management, software implementation? Whatever the domain, there is an audience for it and a digital delivery mechanism for it. Online courses, written guides, consulting packages, templates, membership communities, paid newsletters. The math here is compelling, and most people sleep on it completely. If you build a course that sells for $200 and $200 people buy it over the course of a year, that is $40,000 in income that arrived while you were at your regular job, while you were sleeping, while you were at your kid's soccer game. You created the asset once. The asset keeps selling. That is the fundamental principle of digital knowledge income, and the barrier to entry has never been lower. The only thing stopping most people from building this income stream is the persistent, irrational belief that they are not expert enough to teach anything. You do not need to be the world's foremost authority. You need to know more than the person you are helping, and you need to be willing to organize that knowledge and deliver it. Start there. The fifth income stream is the one people most associate with real wealth building, and that association is correct. Rental income from physical property. I am not going to sugarcoat this. Owning rental property is a business. It requires capital. It requires due diligence. It requires a level of financial literacy around cash flow, vacancy rates, cap rates, and local market conditions that takes time to develop. And if you approach it lazily or emotionally, it will punish you. But here's what the track record also shows. Over long periods of time, well-selected rental property has been one of the most reliable wealth-building vehicles in American economic history for one simple structural reason. The tenant pays the mortgage. While you are building equity in a property that is likely appreciating in value, someone else is making the monthly payment that builds your ownership stake. The cash flow, what is left of the rent after the mortgage, taxes, insurance, and maintenance costs are paid, becomes your income stream. If you buy the right property in the right market at the right price, that monthly cash flow can be meaningful from day one. The key discipline is this. You run every single number before you fall in love with any property. You stress test the cash flow at 90% occupancy, not 100%. You budget for repairs at 1% of property value per year. You factor in property management costs, even if you plan to self-manage, because someday you may not want to. You treat it like the business it is, and you start with one master one, then decide if you expand. The sixth income stream is the one that technology has made newly accessible in ways that did not exist 2 decades ago, and yet most people still have not taken advantage of it. I am talking about becoming the lender, putting your money to work as the bank rather than as the borrower through peer-to-peer lending platforms, private lending arrangements, or more traditional bond investments. The fundamental concept is straightforward. You are providing capital to individuals or businesses who need it, and in exchange, they pay you interest. You are on the other side of the transaction that you have been on your whole life every time you took out a car loan or a mortgage. The interest income that flows from a well-constructed lending portfolio operates entirely outside of the stock market, which gives your overall income architecture something that is genuinely valuable. Decoupling. When your stock portfolio is being hammered by a market downturn, your lending income keeps arriving on schedule because it is driven by loan contracts, not market sentiment. The risk in peer-to-peer lending specifically is real. Borrowers default for, and that is why diversification across many individual loans is non-negotiable. You never concentrate significant capital in a single loan. You spread it. You accept a blended return across hundreds of borrowers rather than chasing the highest yield from a handful of risky ones. Managed carefully, this income stream can deliver returns in the range of 6 to 9% annually, and it does so on a timeline and through a mechanism that has zero relationship to what the NASDAQ is doing on any given Tuesday. The seventh income stream is the simplest, the least glamorous, and the most consistently ignored, which is almost philosophically perfect, because in my experience, the financial moves that feel boring and obvious are the ones that quietly compound into something significant. That stream is maximizing the return on every dollar of cash you are already holding. If your emergency fund, your short-term savings, your cash reserves are sitting in a traditional checking or savings account, earning 0.25% or less in annual interest, you are not being conservative. You are being negligent. High-yield savings accounts and money market accounts at this moment are paying meaningful rates of return, in some cases north of 4 and 5% on FDIC-insured cash. The money is just as safe as it is in your regular bank. It is just as liquid. The only difference is that it is actually working for you instead of sitting there doing absolutely nothing while inflation quietly erodes its purchasing power every single month. Moving your cash reserves to a high-yield account is not a complex financial maneuver. It takes 20 minutes online and it begins generating income the day the transfer clears. There is no reason not to do this today, none. And when you combine that return with dividend income, index fund growth, redistributions, rental cash flow, knowledge product revenue, and lending interest, that seventh stream becomes the foundation that holds idle capital productively until it is deployed somewhere with a higher return. Every dollar in your financial life should have a job. If it does not, you are leaving income on the table every single day. Now, I want to have the most important conversation of this entire video because we have covered what the seven streams are and the mechanics of how they work. But Here is the truth that the financial content industry does not want to focus on because it is uncomfortable and it does not sell courses. The problem is almost never information. You now know what 7 income streams are. You probably knew about most of them before you clicked on this video. So, why do most people watching this right now still have exactly one income stream? I will tell you why. Because starting feels like commitment, and commitment feels like risk. And risk when you have built a life that feels just comfortable enough and feels like something to avoid. So, people perform a mental operation that I find genuinely maddening. They call their inaction caution. They dress up financial paralysis in the vocabulary of prudence. They tell themselves they are being careful, being responsible, waiting until they understand it better, or have more money, or until life settles down. And that self-deception, repeated year after year, is the single most expensive financial mistake in America. It is not a market crash. It is not a bad investment. It is the paralysis of people who could have started and chose the comfort of not starting instead. I have been in enough boardrooms, funded enough companies, competed against enough entrepreneurs to tell you with complete certainty that the people who build real financial resilience are not smarter than the people who do not. They are not luckier. They are not better connected. They started earlier, and they started imperfectly. They opened the brokerage account with a number that embarrassed them. They bought the first REIT share when they did not fully understand the balance sheet. They launched the first digital product before they felt ready, and they improved it based on what happened. The decision to start, made imperfectly and immediately, beats the decision to wait for perfect conditions indefinitely. Perfect conditions do not exist. They never have. The market will always have uncertainty in it. Your financial life will always have competing demands on your capital. There will always be a reason to wait one more month, one more quarter, one more year. And if you keep finding those reasons, you will look up at 55 and realize that every year you found a reason to wait. You also handed a year of compounding back to someone else. That year is gone. The compounding it would have generated is gone. And no amount of urgency in the final decade of your working life fully replaces the decade you spent watching from the sidelines. The math does not forgive. It does not make exceptions, and it does not care about your reasons. Here's your assignment, and I am not making this optional. You are not building all 7 income streams this week. That is not the goal, and it never was. Your goal for the next 72 hours is singular and non-negotiable. Pick one, just one of the 7 streams we covered today. Research it with the same seriousness you would give to anything else that can materially change your financial life, because it can and it will. Open the account, make the first investment, create the first module, list the first property, move the first dollar into the high yield account, take the first concrete, irreversible action that plants a flag in the ground and tells your financial future that you are no longer a passive participant in it. Because here's what I know about financial momentum. The first move is always the hardest, and every subsequent move is easier than the one before it. The people who have the most income streams did not build them all at once. They built the first one, then the second, then the third, and somewhere along the way it stopped feeling like discipline and started feeling like identity. You are not going to retire on one income stream. You are not going to build real security on one income stream, and you are not going to build any of the 7 we talked about today by continuing to watch videos about it without acting on them. The thread is in your hands right now. What you do with it in the next 72 hours is the only answer that actually matters.